Hey, I'm Gene Goldman. Here's a look at the week ahead for the week of June 19th. Number one, because the Fed is so important to market direction. Number two, because we have a quiet week of economic data. And number three, because Fed Chairman Jay Powell speaks at both the House Financial Services Committee on Wednesday and the Senate Banking Committee on Thursday. Let's lay out how the Fed and financial markets are differing in opinion and how Jay Powell may just nudge the market in his testimony this week. So last week, the Fed met, and as expected, they did not raise interest rates. They paused for the first time since March of last year when they began to raise interest rates. But as a sort of hawkish pause, they did update their dot plot with indications of higher than expected rates at the end of this year. As a reminder, the dot plot, I know we've talked about this before, but each Fed member anonymously indicates their thoughts on the economy, on inflation, and of course, interest rates. You look at this graphic, and I love this graphic. This is from our friends over at Yahoo Finance. This compares Fed expectations in last week's dot plot versus the prior one back in March. What we learned from Fed officials is that now they expect to see rates peak at the end of this year at 5.63%. This is up from 5.12% compared to the last dot plot in March. Basically, what the Fed is saying, we are going to raise rates 2 more times and hike rates 1/4%. I know it doesn't seem like much, but the markets don't like surprises. And then if you look at these dots more closely, 3 Fed officials expect 3 hikes of 1/4% or more by the end of this year. And then if you look at this slide where we have market expectations, the markets here are expecting rates to end at 5.24%. So clearly there's a disconnect. The Fed is saying year-end rates will be at 5.63. The market is saying year-end rates will be at 5.24%. So with odds of a rate hike in July at about 72%, the markets are saying economic activity will slow fast, maybe a recession, and or pronounced moderation in inflation will likely persuade the Fed to not raise rates beyond this next meeting in July. If you look at our Fed monitor, we completely agree. Key readings of inflation are slowing down. You're seeing easing of labor market and therefore wage pressure, and you're seeing a moderation in rent likely to occur later this year. And economic activity is slowing pretty fast, especially when you look at forward-looking survey data and other high-frequency readings. We do believe the Fed will be forced to be less aggressive than they have indicated. So overall this week, the key takeaway, the markets and the Fed are not on the same page. Expect Powell to offer more color in his testimony this week. He might try to push market expectations a little bit closer to Fed expectations. And the last thing you see here, we just released our mid-year outlook called Climbing a Wall of Worry. Please get your copy at Cetera.com, from your Cetera Financial Professional, or on our Twitter page. Thank you for listening. For more information, please follow us on Twitter at CeteraIM. See you next week, and thank you.